Dividend decision. Dividend decision relates to disposal of profit. It involves a decision about the proposition of profit which is to be distributed among the shareholders and the proportion of profit which is to be retained in the business for meeting the investment requirements. For example, the decision of a company to use 60% of its profit as dividend and retain 40% of the profit as reserve for future use in business. So what are the factors affecting dividend decisions? Let us check what are the factors affecting the dividend decision. First one is earnings. If the earnings of the company are high, it is likely to declare higher dividends or vice versa. This is because dividends are paid out of current or accumulated profit. Stability of earnings. If the other things that are kept constant, a company whose earnings are stable over the years, it is likely to declare higher dividends, whereas lesser dividend is likely to be paid by a company having unstable earnings. Stability of dividend. In simple terms, stability of dividend means that the dividend rate is kept within a particular range over a period of time. Like for example, a company may decide to declare dividend within the range of 20% to 25% every year. The company usually tend to adopt a policy of stabilizing dividend per share, as wide variations in dividend payouts may adversely affect its goodwill. It is generally perceived that when a company is sure that its earning potential has gone up and is going to be high in the forthcoming years, only then is likely to increase the dividend. On the other hand, if even the earnings of the current year are high, but the company does not expect this trend to continue in future years, it is not likely to alter dividend per share. Growth opportunities. The retained earnings are preferable sources of finance as it does not involve any explicit cost. Therefore, if the company foresees lucrative growth opportunities, it is likely to retain greater portion of its either earnings for investment in these ventures and consequently declare low dividends. On the other hand, the non-growth companies are likely to declare higher dividend. Cash flow position. Since the dividends are paid in cash, a company is in a position to declare high dividend only when it enjoys high liquidity besides high profitability. As against this, even if a company's profitability is high but there is not sufficient availability of cash, it is likely to declare lower dividends. Taxation policies. Since the companies have to pay dividend distribution tax, the existing tax rates have an effect on the dividend payouts. Thus, the decisions about disposal of profit is influenced to a certain extent by the difference in the tax treatment of dividend and capital gains. If the tax rates are high, the company is likely to pay less dividend or vice versa. Under the present tax policy, the recipients of the dividends are likely to prefer higher dividends as they are exempted from paying tax. Stock market reactions. When a company declares high dividends, it tends to create a positive impact on the investors because it leads to a surge in its market price as well. On contrary, declaration of low dividend is linked to poor performance of the company and may have a negative impact on the share prices in the stock market. Thus, the possible impact of the dividend policy on the equity share prices is one of the important factors considered by the management while taking a decision about it.